Hello and welcome to PropNext, the property podcast about all things related to the future of real estate. I'm delighted that you've joined me today. My name is Gavin Morgan, your host. If you'd like to know a little bit more about me, please check out www.propnext.com. That's propnx.com. Or drop me a line if you'd like to chat privately on gavinrmorgan@propnext.com. That's GAVINRMORGAN@propnext.com.
Giles Wrench, welcome to the PropNext podcast, and thank you very much for joining us today.
Thanks for having me, Gavin.
Giles, could you maybe start with a little bit of an introduction to yourself, your career, business, current focus?
Yeah, of course. Well, today I am a chairman in the New York office of JLL, and I co-lead JLL Financial Services, which is the group put together at the end of last year to support all of our clients in the financial services arena, which is broadly described as all the banks, investment management, fintech, as well as the insurance sector.
Plenty of interesting things happening in that space. I can't imagine it's totally unstressful. And maybe just to that point, Giles, could you just set the scene for us a little bit on what's happening in key gateway markets and the challenges that we've read a lot about currently facing the finance sector, please?
Yeah, well, it was all back in March, if you think about it, where things really kicked off, and there was a lot of excitement around the banks, and the reason for that obviously was the most aggressive interest rate increases by the Fed in over 40 years to combat inflation, which back to last summer, just about a year ago, we had inflation running at 9.1%, and as a result of that, the Fed had a succession of interest rate increases. And if you look at where we are today, inflation was 6% plus minus in Feb. It's dropped down to 4.9%, but it's still way above the target of where the Feds would like to see inflation, which is at 2%. And if you look historically at some of the numbers, there's typically, once they've stopped increasing interest rates, on average, it's a 9-month plateau before interest rates start coming down again. I think the net of that is it's going to be the tail end of 24 before we start to see interest rates coming down. Now, the net on effect of that was to put a lot of stress into the banking system. And if you remember back to the beginning of March, it all came at us with rapid fire. First of all, March 10th, the FDIC took over SVB following a run on their deposits. 2 days later, the FDIC took over Signature Bank. And then on March 19th, just a week later, we had UBS at the request of the Swiss government taking over and acquiring Credit Suisse for 3.2 billion. And then more recently, back at the beginning of May, we then had the acquisition of First Republic Bank by JPMC. So a lot happening in a fairly short period of time, bringing volatility.
Yeah, and that's it. When you compress it all as you've done there, it really brings home just how much has happened in the last relatively short while with the sector. And with that news, and I mean, certainly a lot of people anticipating further volatility. I mean, what's your view on the outlook for financial services companies?
Well, I think it's a tale of two cities, if you like, because you have those publicized regional banks that have struggled, and there are some that are in the papers today. I won't name names, but could be the ones next to fall. At the other end of the market, with the larger tier one banks, you've seen tremendous resilience. And indeed, we recently had our JLL Banking Executive Forum down in Kierwa, where we take our top banking clients, and almost to a person of the banking clients that were in the room, they all had pretty stellar Q1 earnings. So I think the better funded, more organised, the larger banks are doing well. And in fact, if you look, here's a good statistic: of 5 of the top 6 since 2019, pre-pandemic, those banks have added a combined 120,000 people to their ranks during that time period, which tells you a little bit about how well those organizations are continuing to do. And if we look at the top 25 occupiers in the financial services arena, 72% have contracted their office portfolios since the onset of the pandemic, but 28% have expanded theirs. And then if you look at banking, the financial services sector in comparison to, say, tech, over the last 12 months, financial services is now the number one leaser of space, 29.4 million square feet in that last 12 months. And that surpassed tech by 3 million square feet. That was for the first time in a long time that financial services has overtaken tech as the most active. And, we're in compared to sort of pre-COVID levels, we're down 16.8% relative. But you compare that to tech, they're down 53%. So it's, as I say, a fairly resilient at the very top end of that market.
Yeah. I mean, Charles, it sounds a little bit like a reemergence of the old economies, or certainly the darling of the older economy. And could you speak a little bit to that? And while doing so, tell us about the decisions that you're seeing that you think set the tone for the future of the banking sector's real estate footprint?
Well, I would say, if you look at some of the emerging markets that we're seeing, which is kind of a little reflective of what they're having to accommodate for. 2019, since then, there's been some real great performers out there by geography. Dallas, which is now referred to as the Wall Street of the South, added 32,000 jobs. Atlanta and Charlotte all performing very well indeed. Dallas now houses the second largest number of financial services jobs in the US after New York. We've also seen some of those traditional financial centers, like New York, for example, they've recovered 97% of their pre-pandemic job level. So new emergence in terms of geographies and also, reasonable performance in some of those traditional financial services centers. I think the second part of your question around, the future of the sector and real estate footprint. If the pandemic was the great resignation, I think as we listen to our clients now, it's very much about the great realignment post-pandemic. We know that our banking clients are looking on the whole at less space. Desk sharing ratios, our research team did good analysis, and prior to the pandemic, you're at about 1.1 person per desk. You're now at 1.4 people per desk, and obviously hybrids here to stay. And some have, really taken it as a way to reduce the bottom line and be more competitive. Others, some of the big names in investment banking here in New York, they're at the other end of the continuum and are very much pushing for more of a RTO that's in keeping with where things were before pandemic. But certainly across the industry, you'd say less space is a trend. The second bit to that is better space, right? We know that people just don't bother commuting and spending the money and the time and the energy of getting into a CBD if the space isn't special. So a lot of that commoditized stock that sits on some of those older avenues in the 70s and 80s stock, it's really difficult to compel people to come to the office if it's not heavily amenitized with all the things that we know. We'll talk a bit about that a bit later, but so that's it. And then I think the third trend you're seeing there is space in places, right? We know 50% of enterprises in North America surveyed by the IDC that they've still got a shortage of qualified staff in those specific jobs. And so where where organizations are looking to recruit in the future to diversify their labor force and get the skills that they need with digitization and other things that are going on are in different places. So less space, better space, space in different places.
Okay. And there's been a cacophony of opinions on AI lately. Also, sort of pivoting a bit to that. How's that changing the industry? And what impact do you think that will have on CRE?
Well, it's it's the subject of the day for sure. You can't not have a dinner conversation or read something in the
Yep.
papers that isn't covering AI and many predictors of either utopia or dystopia. And of course, we all know the Hollywood movies that
Yep.
predict probably dystopia rather than utopia. But I'd say it's already happening. We've seen for example Morgan Stanley using OpenAI's GPT-4 platform as a financial advisor solution to better provide advice to some of their clients. There was a Goldman Sachs report recently that said generative AI, which is obviously the next evolution of AI, could replace up to 25% or about 300 million jobs in the global economy. And 35% of business and financial operations employment in the US could be impacted. So we're it's here now, and in terms of investment, the banking world is expected to be the largest investor with something like 31 billion they're going to invest in AI globally over the course from now until 2025. So it's a thing. There's a huge amount of investment. We've seen a lot of activity as well with some of the traditional banking organizations and relationships with fintech companies. And Morgan Stanley acquired E-Trade a few years ago to better enhance their digital interaction with their wealth management clients. You've seen other international companies like BNP Paribas form alliances with Fireblocks and Medico and Deutsche Bank with NVIDIA. So very much, we are seeing that activity happening, and we're expecting to see more of it as this technology continues to improve and become more supportive of business operations.
And you kind of touched on this in what you just said, but clearly going to drive a need for different types of hiring practices, one would assume. And location-wise, do you think there are any implications there too, Giles? I mean, is there a Silicon Valley for AI, something like that emerging, or a prediction that you want to make there? Just thoughts on that, please.
Well, you've got two things. You've got you obviously need the talent that is coming from the universities and the colleges that is the supply chain for the people with the right skill sets. And so we're seeing more diversification across the US and the activity in those emerging markets that I mentioned before. You've also got a change in tech hiring at the moment, and so places where the tech giants were traditionally hiring and was making it very competitive for the banks to be able to compete and get those individuals. Now you're seeing layoffs in those in that industry, in the tech industry, and that's presenting opportunities which are driven by supply as much as geography, by where the tech giants are laying off those individuals. But I think if you're looking at skill set, what the people are that the banks are looking for now, they have to be experts in things like cloud computing, AI, machine learning, programming, and software developers now is one of the most in-demand roles in the industry. And since 2018, the largest banks have increased hiring for those software developers and data scientists by 90%.
Yeah.
So that's driving them into considering new geographies, new locations to be able to go and get that talent, which is going to be the lifeblood for their competitiveness in the future.
And does that, are there some specific location opportunities that you see around that hiring, or you don't think there's an emerging trend that's saying, for example, it's Boston or the Bay Area or somewhere like that?
Well, it's across the board. We've seen lots of activity in places like Atlanta, um, Charlotte, Nashville, Memphis,
Hmm.
Austin. Has been talked about for a while now, and Arizona, Phoenix. These are all areas that have seen tremendous growth in jobs with financial services because of the ability to provide that different type of talent that the banks now need.
Yeah, all of that, and a lot of those great Sunbelt locations as well. And just then, so with companies leading, particularly in the finance sector, leading the return to the office mandate, what are you seeing organizations in that sector doing to try and get people back to the office?
Yeah, and I have some personal views on this, and we were helping a financial institution think through their headquarters location in New York, and one of the things they asked us to look at was, um, does a heavily amenitized brand new office building, do they have higher RTO than, say, one of their peers that's located in older buildings that are less amenitized, with less of the frills that some of these companies are aspiring to have, and the net result of that was that no, it didn't make a difference, and it was fundamentally driven by the conviction of leadership in that organization to have their people back in the office. And with that, comes a rather strong line, which goes something along the lines of, look, our culture is we are an office-centric business. We believe that's been the success of how we've got where we are today, and will continue to be the success of our business going forward. And therefore, we like to see you in the office. Now, if you're not comfortable with that, or you don't think that culture meets with your aspirations as an employee, we wish you the very best. And clearly that was a harder line to take. When we were in very, very tight labour markets, things have cooled a bit. And I would say, from my purview, it's what do they say about the stock market? There's never a bell at the top, and there's never one at the bottom. And I think you could equally say the same about the pendulum of workplace strategy. And clearly, we're starting to see our office buildings are getting better. People are starting to see there are some negatives. It's not across all of your business, it's not across all of your functions, but there are some things where the younger people want to be and are demanding to be in the office because they realize that's how they learn, and that's how they can be better at what they're doing, and that's how they can propel their careers. And so those competitive folks are actually, at the lower end of the scale. It's the younger ones who are actually demanding to be back in the office. So I think we've seen that shift away from, being purely sort of remote and very hybrid. You're starting to see that pendulum swing back more towards what we knew prior to the pandemic. But with that said, you talk about some of the features and amenities that make that conversation easier. And fundamentally, you want your people to be happy. You want them to be productive. You want them to be in the office, as opposed to the carrot versus the stick. In this day and age of ESG, you're seeing requirements, and you've seen a bifurcation in the marketplace for sure, where brand new product is driving premium rents, and there's huge competition. There isn't much of it, right, which is what's driving up the rents in those locations.
Yeah.
But typically, and here's just some examples of the things that those newer buildings provide. It's platinum LEED certification. Certainly, if you look at some of the things that the banks are doing, HSBC, for example, in New York, moving out of an old location on Fifth Avenue into a brand new building over in the Hudson Yards, where they've been very programmed around development of space that supports neurodiversity in the workplace. Not everybody thrives in the same environment. Create flexibility and choice, and be very purposeful about it. You'll see things like wellness and mothers' rooms, coffee bars. We hear about event space with pop-up food service that brings some level of change and variety and interest. which you're not going to get sitting in your kitchen. Work cafes with healthy snacks. Talked about, the need for different types of spaces, so quiet spaces for those who need a bit of peace and quiet to get concentration on work. Medical centres we see more and more often now, helping employees not have to take 2 hours out of the day to go and making it easy to stay on top of their commitments there. And then, of course, with that, you've got to have really strong infrastructure in the building to support some of those sustainability objectives where you've got state-of-the-art engineering that, maximizes HVAC efficiency and other energy reliability things. So that is a long list, but increasingly that's what we see when our clients want to attract and retain the best talent and they want to get the most return to the office. Those are the things, those are the expectations. And I guess, if there is a silver lining that you can say to the pandemic, as dreadful as it was, is the fact that people, were working in safer, better air quality, higher amenitized, better workplaces now.
Yeah, it's really interesting to hear some of those developments you've talked about. I mean, medical in the workplace, when it just keeps, it continues to become more dynamic. Giles, as we're sort of moving toward the end of the conversation, we'd like to talk a bit about sustainability in this podcast. So just how much is that an increasing determinant in decisions today? I mean, it's been around for a while. It's clearly not going away. It's incredibly important. Are you seeing any dampening in the focus with more constrained budgets on sustainability, or are people embracing that and enlarging it as part of their agenda? Partly around the needs of employees as well, which you've just talked about.
Yeah, it's this is something that's changing, and it's being driven by a number of different angles. And if it was a nice to have 10 years ago, and one could include some very generic language around what you as a corporate were doing around sustainability goals, that has changed dramatically, right? So you've got activist shareholders who are forcing a boardroom a different, more methodical, planned, scientific approach to sustainability and the environment, number one. And number two, you've got a big change in the regulatory environment. And of course, here in the US, we have the SEC impending rules around climate risk that I checked this morning, that's now predicted those will be released sometime in the fall of this year with a retroactive look back around scope 1, scope 2 reporting, which is going to mean that there's going to be much tighter controls and measurements around what organizations are doing for sustainability. And much of that framework is set, lots of acronyms in this one, by the TCFD, right, the Task Force on Climate-Related Financial Disclosures, which is really putting some very stringent rules around how you actually measure greenhouse gas emissions. And then, of course, what the SEC is expecting of organizations, of corporates, is this, better reporting to the TCFD standards around greenhouse gas emissions, number one. Number two, for your business, what are those expected climate risks? And then thirdly, and most importantly, what is your transition plans to manage that risk, right? And this level of scrutiny has not been demanded before across all industries. And then, certainly within banking, you've had the Federal Reserve Board recently launched a pilot climate scenario exercise for 6 of the largest US banks. And we're expecting to see results of those in the fall. And I can name many, many other organizations that are similarly doing this on a global scale in Europe and Asia and so forth. So it's a huge change. With the current economic environment, have we seen a dampening? For sure, we're seeing people really scrutinize every dollar of capital expense. There is an expense, there is a cost to meeting these requirements around the regulatory environment and in general being better global citizens around sustainability. but it's something, because the regulations are quickly catching up, it's going to be even more costly if one delayed.
Indeed. And I completely agree with the variety of different regulations that are coming into play and are going to start having an impact in the immediate term. You just got to keep going and, trying to be best in class and leading in this space. So final thoughts on the best way forward for the finance sector. You've talked a lot about what the sector needs to do, but is there anything else that you'd like to say, particularly anything that speaks to an opportunity for organizations in this sector against the current chaos?
I think it's, and I wouldn't describe it as chaos. I think that's a bit news of the world. You don't mind saying,
Well,
Gavin?
thank you. I'll choose my phrasing more carefully.
Yeah, but I do think, clearly there are challenges out there, and we've got the political socio-economic scene that I don't need to dwell on, but inflation does seem to be trending in the right direction, right, which gives us some sense that those interest rates, like I said lightly, towards the end of 24 may well start to come down, which will ease some of the pressures that we see. The economy needed to cool down. I mean, that's clear, right? You can't have inflation at 9%. So those things, but they take time to work out. And I think, so there are challenges, but there's opportunities as well. And I think in any industry, you always have winners and you have losers. And I think certainly for the financial services sector, for those that can anticipate the change and act quickly, they're going to win. And sort of three key themes there I would surmise, which is, we know AI, digitization, what they're referring to as the fourth industrial revolution, it's here, right? And your ability to embrace that pivot and make that part of your business and be more efficient versus what your competitors may be doing is going to be a big piece of it. The people who are going to support that transformation, as we know, and we've seen it in all of the research and these growth markets that I talked about here in the US, the need to, rapidly adapt to getting the right people into the organization who can support that change is very clear. And then I think, being mindful of the types of people and the way in which they want to work and where they want to work, being mindful of that. Not everybody is created equal. People do have different work styles that allow them to be very productive. And I think even from a sort of direct business perspective, the demographics of the individuals that the wealth management functions of these large banks are looking after, the old wealth management branch that was, big private offices with oak, walls, oak paneling, very traditional, that isn't going to resonate with the 30-somethings, the millennials and the Gen Zs, who want an entirely different digitized supported service. You've seen it a lot in retail branches. You haven't seen it in wealth management branches across the board yet. So I think, any of these financial services organizations that have a real estate strategy that's aligned around those imperatives, they're the ones we're going to see flourish and succeed.
And as you quite rightly pointed out earlier, Giles, there's a lot of organizations in this sector making tremendous profits and with the ability to continue to invest to do all of what you're talking about. So, look, thanks very much. I mean, this has been a tremendous conversation. Great to hear of, what really sounds, in amongst all of the news at the moment, a real resurgence in this sector. Thank you very much for joining us. And I really hope that we can have you on in the future to talk about this again as the situation develops positively.
Thank you.
So that's a wrap. It just leaves it for me now to thank you very much for joining us today on the PropNext podcast. I hope that you'll be able to tune in again to a future show as the conversations develop. If you'd like to contact me, please drop me a note on GAVINRMORGAN@PROPNX.com, or take a look on the website at www.propnext.com. Thanks again for joining us today. I hope to see you on a future podcast. Goodbye.